Before we start this evening's presentations, I'd like to invite Mr. Kashif to come here to recite a few verses from Holy Quran.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم قل هو الله أحد الله الصمد لم يلد ولم يولد ولم يكن له كفوا أحد صدق الله العظيم.
On behalf of Southern Regional Committee, I'd like to welcome you all to our seminar on Global Financial Meltdown. I'd also like to thank our speakers for this evening, Dr. Ishrat Hussain, Director IBA, and second speaker, Mr. Muin Fada, who is the Country Director of Center for International Private Enterprise, an affiliate of US Chamber of Commerce. We are also thankful to Mr. Asad Ali Shah to accept our invitation as session chairman for this evening. The format of the program, ladies and gentlemen, this evening on this topic is that we'll have a presentation by Dr. Ishrat Hussain, which will be followed by Maghrib prayer. Then we'll have a presentation by Mr. Muin Fada, followed with by question answer session, and then this evening's proceeding will be summed up by session chairman, Mr. Asad Ali Shah, President ICAP. Before I invite Mr. Ishrat Hussain for his presentation, I'd like to briefly introduce him. As we all know, Dr. Ishrat Hussain, his personality does not need any introduction. Dr. Ishrat Hussain took over as the Dean and Director of the Institute of Business Administration on March 12, 2008. Immediately before that, he had been holding the offices of Chairman, National Commission of Government Reforms in the Prime Minister's Secretariat in Islamabad. Dr. Ishrat Hussain became the Governor of Pakistan Central Bank in December 1999. During the next 6 years, he implemented a major program of restructuring of central bank and steered the reforms of banking sector, which are now recognized by the World Bank and IMF to be among the best in developing countries. He is regularly invited as a speaker, resource person, discussion panelist, or a chairperson at international conferences, seminars, workshops in different parts of the world held under the auspices of the World Bank, IMF, UN agencies, research institutions, think tanks. He also has far attended 100 such events. With that brief introduction, I'd like to invite Dr. Ishrat Hussain to present his paper on to this evening's topic. Dr.
Bismillahirrahmanirrahim. First of all, let me thank the ICAP for inviting me to this very important meeting. I feel that there is a lack of understanding of the global financial crisis and what its consequences are, and more important, what are the lessons. We all seem to believe in rhetorics, slogans, and platitudes. And one of the most popular platitudes these days is that capitalism is dead and nationalization is the word which will prevail over the entire, global finance. If we draw the wrong conclusions, we are going to make even more mistakes. And therefore, it is important to put this in the proper perspective. And an audience as sophisticated as yours should try to sift the facts from myths and fiction. So it's all right for the media pundits to come and sensationalize the issue, but for professionals like you and me, we owe it to ourselves and to our professions to make a more rigorous and more in-depth analysis of the issues. The last several years has seen an expansion in the world economy which is almost unprecedented. And even a country such as China, which was suffering from starvation and famine conditions before 1978, decided to open itself up and integrate itself into the world economy and become a powerhouse for the world economy to the extent that it's financing the current account deficit of the United States. It increased in the process the purchasing power of the American people. And how did it do this? That by becoming the factory for manufactured goods of the world, it started providing basic essential goods, raw materials, and machinery at a cost which was almost half of what the United States or the Western Europeans could afford or could produce. So the affordability of the US citizens therefore increased quite substantially. Along with this came the monetary easing by the Federal Reserve by cutting down the interest rates. And this increase in the purchasing power led to a higher demand for goods and services led by the construction of housing or the mortgage industry. The interest rates came down substantially, the monetary conditions were eased, the economic growth was taking place, the asset prices were rising. So it made sense for an ordinary citizen of the United States to borrow from the commercial banks or the mortgage companies, acquire a real asset whose value is going up and up. And thereby, you are building up your equity capital without much difficulty. The financial innovation and technological revolution at the same time facilitated this process by bringing in the securitization of the mortgages. In the conventional banking model, you originate the loan and you retain on your balance sheet. And therefore, the risk management, both at the time of credit appraisal as well as throughout the life of the loan, remains that of the originating bank. But when you start securitizing them and you have an originate and distribute model along with slice and dice, which means that you have tranches of the securities which are AAA, AA, A, and so on, the originator of the loan does not pay much attention as far as the repayment capacity of the loanee is concerned, or doesn't care about the creditworthiness of the potential borrowers, because the risk has been transferred from his balance sheet to off balance sheet or to other companies like the insurance companies, like the hedge funds, the private equity funds, the pension funds, and other institutions. So while financial innovation is diversifying the risks from the commercial banks, where the risk ultimately resides is a black box. Because even the people other than those who were carrying out the financial innovation did not understand or comprehend where this risk which was transferred ultimately resided. So you have consequences of financial innovation under easy monetary policy, lower interest rates, the dream of every American to own a house. At the same time, instead of trying to manage the risk the way it should be, we create a perverse incentive for risk management. The other side of the coin is that after the Glass-Steagall Act of 1930 was repealed and the boundaries between the commercial banking and the investment banking disappeared, and you had a universal banking, the business model for investment banks did not make any sense. Why do I say that? And I said that to the Fed Reserve representative at the Asian Bankers Summit in Hanoi in January 2008. And I would like to repeat what I said. I said to them that the investment banks borrow high-cost funds from the wholesale markets, and they leverage and over-leverage that money into illiquid asset acquisition. And it is a single product line. But the commercial banks under the universal banking model have a recourse to retail deposits which are cheap and which are stable. And they use that deposit base for diversifying their portfolio over a large number of products: commercial, consumer, corporate, SME, and you name it. Therefore, the risk diversification on the asset side is pretty good on the commercial bank side. And the source of funding is cheap. Now, how can you really compete in this model if you are Merrill Lynch, or if you are Bear Stearns, or if you are Lehman Brothers? So there was a flaw in this, and it is only recently that the Federal Reserve, after the collapse of the Bear Stearns, after the collapse of Lehman Brothers, and after the acquisition of Merrill Lynch, decided to convert Goldman Sachs and Morgan Stanley into bank holding company. So they are just like the Citibank and JP Morgan and Bank of America. They have become just the commercial banks. This should have happened long time ago rather than after being hit by such a tremendous crisis. But that's not the end of the story. The commercial banking is being overregulated in my view. You have the Fed Reserve, you have the Office of Comptroller of Currency, you have the FDIC, you have the SEC, and the State Superintendent of Banking. So all these guys are spending enormous amount of manpower and time looking after the bank holding companies. But the shadow banking system, where all the financial innovation is taking place and where the risk is being transferred from the commercial banks, like the insurance companies, like the stockbroking, the investment banks, the private equity, and the hedge funds are either unregulated, poorly regulated, or underregulated. So you have a mismatch between the risk tolerance capacity of commercial banks and their regulators and the capacity of the regulators and the sophistication of the market players. And this mismatch, in my view, is responsible for what happened in the subprime mortgage crisis. August 2007 was a turning point when the shoe began to pinch. Because when you lend to the people who have no capacity to repay, or you even give them negative equity in the sense that the equity is built up in the loan, that because the market price of the house is going to go up, I give you 110, and 100 is loan, 10 is your equity, but this is a loan, because next year the price will go up from 110 to 120, so you will be better off this way. When some of the companies start getting defaults on the subprime, the domino effect started throughout the process. It started with the balance sheets of the big commercial banks because they originated, and through special investment vehicles, SIVs, some of them were still off the balance sheets. And because these losses, thanks to the international accounting standards, are now marked to market, so as soon as the assets started losing their value, you have to mark them to market. What does that mean? That you have to raise capital in order to compensate for those losses. As long as the sovereign wealth funds, like the Abu Dhabi, China, Singapore, Kuwait, who had made a windfall gain out of the oil prices, felt that they were buying, triple A rated banks like Citi, like Merrill Lynch, like Morgan Stanley, JP Morgan, things were okay. And out of 450 to 500 billion losses of the commercial banks, they were able to raise capital at fairly reasonable rates for 350 to 400 billion. So the commercial banks were able to withstand this shock by finding the capital. Insurance companies, which were held by other players in the market, including the two big players like the Freddie Mac and the Fannie Mae, when the chickens came home to roost, they didn't know where to go. They can't go to the lender of last resort because they are not being governed by the Fed Reserve. They don't have the firewalls like the commercial banks have because they have a single product line. And they don't have their own capital because the leverage ratios, unlike the commercial banks, where the leverage ratios were maybe 10, 15, the leverage ratios here were 30, 40. So when you have a downside slide, you know as accountants better than me who is going to take the hit. So there was no capital in order to compensate for the losses of what I call is the shadow banking system. What happens then? You have Bear Stearns, the first example, where JP Morgan felt, under the influence of the Fed Reserve, that if you acquire, this is a good line of business, and we will make, some money. But when Lehman Brothers also comes to the Federal Reserve, they have to make a decision. And you and I may have different perspective as far as that decision is concerned. Is it moral hazard to bail out an investment bank which is not regulated by Fed Reserve? Where do you draw the line? And on that analogy, Mr. Paulson decided that he's not going to allow Fed money or the US Treasury money to bail out Lehman Brothers. But Lehman Brothers' exposure was not limited only to itself or its borrowers. It was all throughout the banking and the non-banking financial systems. AIG, which on the insurance side, and Mr. Fuda will tell you more about it, was okay. On the financial product side, they had a huge exposure through the credit default swaps. And when Lehman Brothers defaulted on its own, AIG and insurance companies, monoline insurers, they all got into trouble. Not only they got into trouble, the European banks also got in trouble. And the biggest example was that when Mr. Paulson announced the rescue package of $700 billion for all the banks who are domiciled in the US, so Deutsche and Barclays and HSBC and Paribas, Agricole, Societe Generale, they were all protected because they have presence in the US. But Fortis, which is a Belgian bank, which had market cap 3 times the GDP of Belgium, was not domiciled in the US. So the market reaction in Europe was Fortis is going to go down. Not only that, there were some questions about Fortis' acquisition of ABN AMRO Dutch and Belgium operations, that they paid too much. And Mr. Vautrin, who was the chief executive of Fortis Bank, had already lost his job. So the market put 2 and 2 together. There's no protection for Fortis. And Fortis has paid too much for its franchise in Netherlands and Germany, and in Belgium. So the Belgium and Netherlands governments had to come to the rescue of the Fortis Bank. And then it started with HBOS in the UK, where Lloyds Bank had to come in. But this was not ending. So Mr. Gordon Brown, and he deserves the credit, said this is just not going to go on this way. The problem is more deep-seated because interbank markets were drying up. The money market funds were just going to become completely bankrupt. Because in interbank market, it is a sentiment. If I have surplus funds, I'm very happy to give it to those institutions which have demand for a certain period of time. That's how interbank market works. But if I don't know whether this particular counterparty is going to pay me back, and I'm also under the threat that my own depositors may come for redemption, what do I do? And there are some bankers sitting in here. I withhold the excess liquidity to myself, and I'm not going to part with it. If I withhold the excess liquidity and the banks which are short of cash to meet even their SLR requirements, where do they go? So this is what I call as the nerve center of the entire banking system, which is the payment system. So the payment systems are going to become totally, dysfunctional. That's why the US government was more concentrating on purchasing the toxic assets so that the capital could be freed for the banks to start operating as a normal bank. So it was a bad bank, good bank distinction. Gordon Brown said we have to have a more comprehensive rescue package, which says we will put money into recapitalizing the banks themselves directly, rather than we will buy the toxic assets, but we will also guarantee the interbank markets to inject the liquidity. And then it was caught on by the US, it was caught on by the Europeans, the Germans, and Ireland was the first country which said we have blanket guarantee for the depositors. Now when you have one part of the European Union saying you have blanket guarantee, and if I can transfer my money from Paris to Dublin because my deposits are protected there, what should the French government do? Or what should the German government do? Or what should the Spanish government do? They have to do the same thing. Otherwise, there will be a transfer of deposits from one jurisdiction to another within a common union. This is a common union. So that's where this contagion effect was going to take both Europe as well as the US financial system into serious spate. Thank God that, at least for the time being, these measures by the public sector intervention have been able to avert further damages to the system. Where it's going to end, whether this asset class, which is right now only the mortgages, mortgage-based securities, credit default swaps, is that going to be the only area which is infected and contaminated? Or is it going to transfer to the credit cards and other banking products? Is still to be seen. It's a question mark. And that leads me to the consequences on the real sector of the economy. Housing assets, as they increase in price, create what economists called as a wealth effect. And the wealth effect is that now I have become richer, not by the dint of my hard work, but because my house used to cost $100,000, now it costs $200,000. And the wealth effect stimulates increased consumption. And that is how the economy's aggregate demand rises. The flip side is, as the housing prices decline and you have more defaults or foreclosures, you have negative wealth effect. That means your consumption is lower because you want to save for a rainy day. As you withdraw your consumption, the demand for goods and services in the economy declines, unemployment rises, and you are in a recession. So the US is likely to have a 0.5% growth rate in 2008 and perhaps 0.1 or 0.2% growth rate in 2009. Europe is almost about the same. But surprise, surprise, the world economic growth rate is going to be 5 or 4.5%. How come? Europe and the United States are less than 1%, and there, the rest of the world, particularly Asian countries, come in. The developing Asia has been insulated from this global financial crisis so far. Let's keep our fingers crossed. Developing Asia's growth rate is going to be 7%, and China's growth rate is going to be 9 or 8. There is a difference between 8 to 9%. That is providing the boom to the world economy. So the power relationship in the world economy has changed to the extent that the engine of this locomotive is not United States or Europe. The engine of this locomotive of growth for the world economy is Asia, and particularly China. This is something which we should recognize because we always look westward. All our business people are obsessed with the United States and Europe. They are not realizing that the world around them has changed completely, that the world is now moving and shifting eastwards, and they have to position themselves towards those markets which are booming, which are likely to boom, rather than those which are stagnating and which are dependent on countries like Japan and China for their survival. That's a lesson which I wanted to bring to this audience because we are still in a deep slumber. We are sleeping, and we don't realize how the global economic equation is changing and changing so rapidly. The second question arises, what about us, Pakistan? Because I think a lot of you have told me that I should not just confine myself to the global situation, but relate it to our own situation, because this is the uppermost question on your mind. And if I had not done this, this will come up in the question answer. So let me share my own thoughts about you. The global financial crisis is not our enemy. It's not going to damage our economy. We are our own enemies because for the last 18, 20 months, when the global economic environment was so turbulent, we did not manage the economy, the ship of the economy, with a heavy hands on the steering. And that's what has led to the current situation where you have rising fiscal and current account deficits, attack on the rupee exchange rate, declining reserves, and a lack of confidence which is leading to the capital outflows. So this was happening even before September 2008, when the global financial crisis hit everyone. Secondly, we are insulated, like China and India, and wisely so, from the direct effects of the global financial crisis. If you remember, in 1997, Thailand, Philippines, Malaysia, Indonesia, Korea suffered a great deal. But 3 countries didn't even have a scratch, which was China, India, and Pakistan. Why? Because we have insulated ourselves with a firewall, which is that we have capital controls. We don't have full capital convertibility. And the reforms of the banking sector for over 15-year period have made our banking system very robust and resilient. Therefore, the transmission mechanism from the global financial crisis to Pakistan's banking sector is almost negligible. Yes, there is a herd instinct. If the bankers feel that unsubstantiated rumors, SMSs, and the television breaking news are giving rise to a panic in the markets, they will withhold their liquidity. They will not dispense with their excess money. And as I said, this is how the markets work. So the markets were high and dry because you didn't have the liquidity into the interbank markets. And it is a job of the central bank to provide liquidity unlimited. That has nothing to do with the monetary policy stance or the interest rate regime or whatever you may do. In a crisis situation, to avert the panic, you have to do it the other way. You have to flood the markets with liquidity, and that's exactly what they have done. They have put in 270 billion. I think the Pakistan Banking Association asked for 300 billion, and they put in 270 billion. But we are our worst enemies. I have never received so many phone calls and SMS messages and emails after Eid as I did that week, where very sensible and educated people and women were saying, we want to take our deposits out of the banks, we want to take our lockers out of the banks. Now, if you do that, this is a self-fulfilling prophecy. Because the moment you start taking out your deposits, you're making sure that the entire banking sector collapses. Because you do this on one bank, and 2 or 3 banks were targeted for that. I don't know for what reason. I just don't understand. And there was 2 or 3 days of complete terror, and for no reason or rhyme or reason. And I think we don't need outsiders to destroy us. We are very capable of destroying ourselves. And this, to me, is a lesson which I draw from this episode, that the negativity, the cynicism has permeated our national psyche to such an extent that we are not prepared to do anything but to disbelieve every positive thing which can happen. And that's a price we have to pay. So I have gone on the TV channels, and I'm very straightforward in telling you that if you continue this herd instinct of creating all these rumors, unsubstantiated, and create panic, then nobody can save you. Whatever the robust the banking system is, it is just not going to do anything good for the country. Particularly when we have the macroeconomic crisis looming large in our face. You have fiscal deficits, you have capital flight, you have an exchange rate which is depreciating rapidly, and if you bring this side also, then God save us. So my plea to all of you, and some of you present here have also sent me the SMSs and phoned me, I want to tell you that please do not fall in this trap. That's my appeal to you as a Pakistani. And I say this with full authority, that your behavior is going to determine whether we will survive this crisis or we will not survive this crisis. And I hope that good sense prevails. I think it's a time for Maghrib prayers, so I will stop here, but I'll be quite happy to answer any questions later on. I didn't want to give you a sermon, but I wanted to explain to you about the genesis of the global financial crisis, its consequences, and what its repercussions are. The good news is that the declining commodity prices of fuel and food is going to do good for the country because our imports bill is going to decline. Our inflation, which is imported inflation, is going to be lower. Because of the depreciation of the exchange rate, our exports are going to go up. So even in this crisis, there are some silver linings for countries like Pakistan. Of course, Saudi Arabia, UAE, Kuwait, and other countries will suffer, whether they suffer to the extent that they retrench the employment and therefore the remittances go down is a question mark. But with the windfall gains of 645 billion earned only in 2008, and they don't know what to do with that money, I don't foresee such a retrenchment coming in the next 1 or 2 years. So if the remittances continue to go up, your import bills go down, your exports, and the non-traditional exports have gone up by almost 30% during the last 6 months. Textiles haven't done so well, but the non-traditional have done, because what was profitable at 60 rupees is now profitable at 80 rupees, because your earnings have gone by 25%. So what you can sell in the international market for $1 now fetches you 80 rupees. And if your cost of production is only 70 rupees, you will export it. That's the way it works. So I personally think that despite this very negative global scenario, countries like India, Pakistan, Bangladesh will benefit from the decline in the commodity prices, the fuel prices, and the food prices. Thank you very much.
A very detailed and elaborate presentation. Ladies and gentlemen, we'll break here for Maghrib prayer for about 15-20 minutes. If I can request you all to be here by 7:35 so that we can start our second presentation. The arrangement for prayers have been made on the second floor. People who cannot go on second floor, we've also made some arrangement here and downstairs as well. Thank you. 2005. Prior to joining CIP, Mr. Foda served as the Managing Director of Karachi Stock Exchange for 3 years from September 2002. He was elected President, Management Association of Pakistan from July 1999 to June 2001, and has also served as a member of the Privatization Commission from February 2000 to April 2007. In recognition of his valuable services in the field of public service, in March 2006, he was conferred the Civil Award Sitara Imtiaz by the President of Pakistan. With that brief introduction, I'd like to invite Mr. Moin Fazal to present his paper.
I think we'll have to slightly modify this. And Moin Saab, if you don't mind, I think we'll have a few questions at this stage from Dr. Ishrat because the presentation, his presentation is fresh and we discussed the global financial meltdown. So perhaps we can have a few questions at this stage and then we'll have second presentation.
Okay, ladies and gentlemen, the floor is now open for...
So maybe 4 or 5 questions at this stage. Okay, and the format is the same. Please identify yourself and just straight away come to the question.
Well, my name is Hassan Salim, and I have a question for Dr. Ishrat Hussain, and that is that how do you foresee the aspect of government guaranteeing the depositors as well as the interbank borrowings, the way other governments like Western Europe and Australia, New Zealand have done? So how do you foresee this thing happening in Pakistan?
it is a decision of the government and the central bank. When you guarantee something, it has to be backed by the real resources. And at this moment, if you give the guarantee and the guarantee is called, you should be able to pay that. So it is for the government of Pakistan and the central bank to decide whether this is the appropriate. I personally think that our banking system is very much insulated from the global financial crisis that doesn't call for the same measures.